Today we're going to talk about the most famous stock market crash in history, the Wall Street bankruptcy of 1929. We are going to give what caused the crash, what happened next, and lessons learned from this historic event. Background. During the 1920s, the United States experienced a period of economic growth and prosperity known as the Roaring Twenties. The country was booming and the people were enjoying new prosperity. The stock market was seen as a symbol of this newfound prosperity and was a huge source of speculation and investment. People invested their savings, borrowed money to buy stocks, and tried to make a quick profit. Many Americans believed that the stock market would continue to rise indefinitely. The crash. On October 24, 1929, the stock market crashed. This event is known as Black Thursday. The Dow Jones Industrial Average lost 11% of its value in one day, and investors lost billions of dollars. The crash was the result of several factors that accumulated over time. One of the main causes of the crash was the practice of buying stocks on margin. Margin purchases allowed investors to buy stocks with borrowed money, allowing them to invest more money than they actually had. This led to rapid credit expansion and speculation in the stock market. When the market started to fall, investors who bought on margin were forced to sell their shares to pay off their loans. These sales caused the market to drop further, leading to a vicious cycle of panic selling. Over the next few days, panic selling continued and the market continued to fall. As of Tuesday, October 29, the market had lost 30% of its value from the previous month. Today, this day is known as Black Tuesday. The aftermath. The crash of 1929 had far-reaching consequences, not just in the United States, but around the world. The stock market crash led to a widespread economic crisis known as the Great Depression that lasted more than a decade. Many banks and businesses went bankrupt, and unemployment skyrocketed. The effects of the Great Depression were felt around the world, with many countries suffering similar recessions. The Great Depression had a profound effect on American society and changed attitudes toward business and government. The New Deal, a series of government programs and reforms, was introduced by President Franklin D. Roosevelt to combat the effects of the Great Depression. Lessons learned. The crash of 1929 taught us an important lesson about responsible investment. It showed the dangers of speculation and risky investments in the stock market. It also emphasized the importance of diversification and investing in different types of assets rather than relying solely on the stock market. Another lesson learned from the crash is the importance of government regulation. Governments have a role to play in stabilizing the financial system and keeping it free from excessive speculation and exposure to risk. Conclusion. In summary, the Wall Street bankruptcy of 1929 was a defining moment in American history. He showed us the dangers of speculation and risky investments in the stock market and taught us important lessons about responsible investment and government regulation. The crash of 1929 had a profound effect on the world economy and changed the way people thought about the stock market and the role of governments in regulating it. The lessons of the crash continue to shape investment practices and government policies to this day. I hope you found this video informative and interesting. Thank you for watching.